Hi, this is Professor Hazara, and this is close, yay, to the last module of this course, and this is on international financial statements. Now, the question, this is going to be a short video. There's going to be 3 videos in this one, and I think 2 are the most important. The first will be the most important, this one, the next one, because this is the introductory video, and then we're going to have I'm going to show you 2 ways to restate financial statements. And when we say restating financial statements, as it says here, I can start my slideshow here. Just made these slides. In both International Financial Reporting Standards and US GAAP, there are 2 methods for restating financial statements from one currency to another. And this is obviously a problem for companies that own other companies who report in other countries. So you may have a US parent that owns a company in Europe, let's say Germany, whatever, in continental Europe, and they would express their financial statements in euros. Okay, so before consolidating, you would have to take the foreign subsidiary's financial statements, restate them to US dollars, and then do the consolidation, because the US reporting currency is obviously the US dollar. Okay, now there's 2 methods for restating financial statements. One is called, as you can see my pointer there, translation, and that's the one you should know both, but translation really is the one that's commonly used, and it's commonly used for a very pragmatic reason. Okay, and the other one is called remeasurement. Remeasurement is conceptually more correct sometimes, but practically more difficult, which is why translation companies like to use translation. Okay, the conceptual basis for using one method versus another is based on a concept called a functional currency. Okay? And this is something you should know, because my bet would be there's a good chance you may see a small question on this, the CPA exam. An entity's functional currency is basically the currency in which it operates. Okay? And so what you have to do is when you're a parent company, I'm going to stick with the parent company of the United States, and you've got a foreign subsidiary, you've got to ask yourself, we're going to assume that the parent is reporting currency and functional currency. One is reporting, the other one is the currency that the parent operates in. We'll kind of assume that's the US dollar in both cases. However, there is and the entity's reporting currency, the foreign entity's reporting currency, the subsidiary, is going to be, in this case, let's assume it's Europe. So it would be the euro. That would be the reporting currency. But there is a possibility that the foreign subsidiary, that their functional currency, their operating currency, may actually not be the euro, but the US dollar. There is a scenario where that is possible. And that would be the scenario, by the way, for remeasurement. Okay, so what you've got to do, this whole concept is, you know that the reporting currencies are different. The US parent reports in dollars. The European subsidiary reports in euros. Okay? And you got to ask yourself, assuming that the US parent's operating currency or functional currency is the US dollar, what is the foreign subsidiary's functional operating currency? Okay, and so let's go to conceptually. The functional currencies of the parent and subsidiary are different. And remember, when I say functional currency, I mean really operating currency. What is the currency in which they buy their inventory? What is the currency in which they pay their workers? What is the currency in which they sell their products? That would be the operating currency of either the parent or the subsidiary. You got to ask yourself, what is its major operating currency? A lot of times, the costs, the currency in which the entity accumulates its costs through work in process, all the inventories you should know through cost accounting, that a lot of times it's its operating currency. Okay, so restatement of financial statements. Okay, so let's say that you have this situation here. You're in the United States, U.S. headquarters. Dollar is the functional currency. Also assume that the reporting currency, the currency which expresses financial statements, is the functional currency. Okay, let's say this subsidiary produces cars for Germany. Okay, and let's assume that the subsidiary produces cars in Germany for Germany. I should have put that, in Germany for Germany. but I'm assuming that they're in Germany, and so the euro would be its functional currency. Now, notice what I'm saying by having these two in different blocks here. I'm saying in the United States you have U.S. parent. It's probably got some factories in the United States, and its functional currency would be the U.S. dollar. The subsidiary, if it produces cars in Germany for Germany, and for export to other European countries in the European Union, the euro would be its functional currency. I'm assuming, and pretty much that means that if your functional currency is, in this case, in Germany, that means you would have factories in Germany. So in this case, you would have companies operating in, that's why I have different blocks, two different economic environments. You'd have the U.S. company producing cars, let's say, for the U.S. market with factories in the United States producing cars for the U.S. market. And then you have a German subsidiary producing cars in factories in Germany, paying its workers in euros. Its customers are paying in euros. It's buying its inventory in euros. So it would be in the European economic environment. Now, when this is the case, when you have a U.S. company whose functional currency and operations are in the United States, and when I mean operations, I mean they actually manufacture things in the United States, and you have a German subsidiary. Keep in mind, subsidiary means the parent U.S. headquarters owns the German company, but the subsidiary operates in the German economic environment, meaning, or the European economic environment, means it has its factories in Europe, it pays its workers in Europe, which would be euros, it buys its inventory in Europe. It's operating in Europe, so the euro would be its functional currency. When you have this situation where you have two different economic environments because the parent and the subsidiary have different functional currencies, this calls for translation. As can be seen, under translation, the parent and the subsidiary operate in different economic environments. Now, I put in this slide here, I say consistent with this concept. You really won't understand why I say consistent with the concept. Might mean, you're saying, well, they operate in different economic environments, so why would you use only, as it says there, one currency, the current, right? Well, you'll see in the examples, but it is consistent with the concept. So you have a parent in its own economic environment because its functional currency is the U.S. dollar. It operates in the U.S. dollar, pays its workers, sales, customers pay the sales revenue in dollars. It buys its inventory in the United States, so that's all dollars. Okay? And then you have a German subsidiary. It's owned by the U.S. company and controlled by the U.S. company, but it operates in Europe, and its sales are in Europe, its inventory is in Europe, and its workers are in Europe. So everything is flowing in and out in euros. When this is the case, you use what we call translation. You're going to take the subsidiary statements, and there's two rules here. I don't know if you can see any pointer. There's my pointer. Basically, we call it the one rate method because we're going to use one rate for both monetary assets and both monetary and non-monetary assets and liabilities. And that's so important. I'm actually going to change the slide here. It says only one rate is used. The current rate for both monetary and non-monetary assets and liabilities. Now, I believe, for one, that you should know the difference between monetary and non-monetary asset and liability. Okay, here's where we are. Here's my pointer. Okay, so basically one rate is used, the current rate. You're going to use the current exchange rate for both monetary and non-monetary assets and liabilities. Now, what is a monetary asset and liability, and what is a non-monetary asset and liability? I believe probably you should know this by now, but I'm going to say it anyway. Monetary assets and liabilities are cash or any assets and liabilities that are fixed by contract in terms of the cash you will receive. So it just basically means cash, accounts receivable, all receivables, and all payables. And maybe some types of short-term securities, bonds payable in the long term, maybe some types of short-term securities. But basically, they're liquid securities. Cash, accounts receivable, accounts payable. Those are monetary assets. Non-monetary assets and liabilities are things that you generally value at historical cost. Basically, property, plant, and equipment. Hard assets. Those are non-monetary assets. So what we're saying here is that when you use translation, you're going to use one rate, the current exchange rate as of the date of the financial statements for both monetary assets and liabilities, which are cash, receivables, and payables, and maybe a couple other things, and also for things, for items, assets, and liabilities which are usually valued at historic cost, such as property, plant, and equipment. Now you may start seeing an inconsistency here. It makes sense to value cash and receivables at the current exchange rate because that's what they're worth. Their worth is based on the current exchange rate. But if you're going to value, let's say the subsidiary has some land overseas, which is usually recorded historical cost, what's going to happen here is that you're going to take historical cost of that asset, in, let's say it's land in Germany, and you're going to apply the current exchange rate to it. That's kind of inconsistent. It doesn't really make a lot of sense, at least theoretically, at least initially theoretically. You're taking something that's valued overseas that you own, that is valued at historical cost, like a building or factory or land, and you're translating it, you're restating it. You're going to multiply that amount, historical cost, times the current exchange rate. To get the historical cost, actually you should, theoretically use the historical exchange rate when you bought the thing. But we'll get to that. We'll get to the reason. And that's why this is conceptually inconsistent, but it's very practical. You'll see. Okay, now, here's two things that are very important in the second bullet point. The restatement adjustment is cumulative. So the restatement adjustment, we're going to actually have what we call restatement adjustment, and it's going to be, we're going to restate, we're going to take all the items of the financial statements. You'll see what we get here. And we're going to take all the income statement and balance sheet items for all the items for the subsidiary, and we're going to multiply each one times an exchange rate. In this case, basically the current rate for just about everything. That adjustment is going to be cumulative, meaning that's going to be the cumulative adjustment. That's the time you acquired the foreign subsidiary, and it does not go to income. It goes to OCI and shareholders' equity. So let's go over these rules one more time. When the functional currency of the parent and subsidiary are different, use translation. Okay, that usually happens when the functional currencies, the operations of each company are in different economic environments. In this case, we're assuming that the U.S. operates and reports in dollars, and the German company reports and operates in euros. That means you operate in two different economic environments. That calls for translation. Under translation, you're going to use one rate, current rate for both monetary items and non-monetary items. Okay, monetary items being cash and account receivable and payables, and non-monetary items being property, plant, equipment, hard assets. The adjustment is cumulative and goes to OCI. Okay, so that's one thing. Now let's go to another situation. Let's say the U.S. headquarters dollar is the functional currency, and the U.S. Has a factory. Cars are made in the U.S. now. This is a different situation. Cars are made in the U.S. and exported to Germany. So what we're saying here is we've got a U.S., the dollar is the functional currency, and the factory is in the United States. Cars are made in the U.S. and exported to Germany. So the U.S. is actually an exporter. Okay? In Germany, you don't have a factory. You just have a subsidiary office, which basically takes control of the cars. A subsidiary is a sales office, which sells cars exported from the U.S. So in this case, the dollar would be the subsidiary's functional currency. Now you may be asking why. The subsidiary would probably take the cars. They come in on a ship. The subsidiary gives them, let's say the subsidiary is a sales office that distributes them to dealers, but the subsidiary basically takes the cars and sells them. In this case, the argument is being made that the subsidiary's functional currency, since there's no factory it's paying, is actually the U.S. dollar. Because on the cost side, this is pretty obvious because the cars made in the United States, and the subsidiary, all the subsidiary is doing is representing the U.S. headquarters. So in a sense, the subsidiary in that case sense is an extension of the U.S. company because it's just a sales office, an importer in a sense. But they may have an official brand for Germany when it existed, let's say. had an official brand, and it was just importing cars from the United States. Okay, so the subsidiary is the sales office, which sells cars exported from the United States. The dollar is the functional currency here. But of course, the subsidiary, if it reports, even if the subsidiary is just a sales extension, sales division, it may actually quote on European exchanges, so its reporting currency would be the euro. Okay, but the functional currency is really the same here. So the situation is different here when you have a headquarters in one country which makes things and exports to other countries, and it has a sales office which is a subsidiary. Sales office, their functional currency is really the same functional currency as that of the headquarters, which makes the product and exports it. This calls for this situation. That's why I'm putting this arrow here. They're in a sense working in the same economic environment, and that's why I'm putting a big block around the whole thing right there. Okay, under this situation, the parent the subsidiary, in a sense, operate in the same economic environment. This calls for remeasurement. Okay, so, and I'm going to go ahead. These are new slides here, so I'm making them. I'm just going to say this situation leads to remeasurement. Okay, and consistent with the concept that they operate in the same economic environment, what remeasurement does is remeasurement I'm going to save the slide here because I'm going to put them up for you. Okay, remeasurement does things a little differently than translation. Okay, under remeasurement, consistent with this concept, basically only two rates are used: the current rate for monetary assets and for both monetary assets and liabilities. So you're going to use the current rate for monetary assets and liabilities, and the non-current rate for non-monetary assets and liabilities. And this conceptually makes more sense than translation, because here what you're saying is that for cash, for monetary assets and liabilities, for cash, receivables and payables, you're going to take their value in the foreign currency and multiply that value times the current exchange rate. And that makes sense because they're valued at their current value. Cash obviously goes up and down. The foreign value of cash, as you saw from the transactions, goes up and down with the exchange rate. The same holds true for accounts receivable and accounts payable and other receivables and payables. And now the non-current rate is basically a historical rate which existed when the other company purchased land, buildings, or whatever. And so that makes sense from an accounting perspective, because if you have a non-current rate, you're going to use a bunch of non-current rates because you purchased all these different non-monetary assets and liabilities at different points in time. But if you have a piece of land you purchased 5 years ago, to get the true historical cost of that land, you should take the cost of the land in the foreign currency and multiply it times the historical exchange rate that existed when the land was purchased. The same thing. So non-current rates are the rates that existed when the other company acquired those particular hard assets, land, buildings, equipment. So it makes more conceptual sense. And then the second point is that the restatement adjustment is only for, it's not cumulative, it's only for the current period, and thus goes to net income. Okay, so let's go over this one more time. I know I'm going back and forth here. Let's say you have U.S. headquarters. Let's go to okay. So let's say this is remeasurement, and I'm going to do one last review of these slides here. Remeasurement, it happens when the U.S. headquarters basically makes something, manufactures something, and exports it to another country. And in the other country, you have a sales subsidiary, which is a sales office, and just imports the cars and sells them. Basically, it distributes them. There's probably different ways to do this, but in that case, the U.S. dollar would be the functional currency of both entities, and they both work in the same economic environment. And as can be seen from the exhibit under remeasurement, both the subsidiary and parent work on in the same economic environment. This leads to remeasurement consistent with this concept. Only two exchange rates are used, and I'm saying only two. Basically, there are two: the current and non-current. But there is a point that makes it complicated, and I'll finish this video with this. Consistent with this concept, two rates are used: the current for cash, receivables, and payables. Those are monetary items, liabilities, assets, and liabilities, and non-current rate for items non-current monetary assets and liabilities, which are valued at historical cost, which makes perfect sense because to get the historical cost of something that was purchased in another country, you have to take the foreign currency in which it was costed, purchased, and then multiply it by the rate that existed at the date of purchase. Okay, and since this makes consistent sense from a balance sheet perspective, as it comes out, what you end up getting is the restatement adjustment is uh, only for the current period and doesn't go to OCI, it goes to net income. Okay, so that's it. Now, there's one reason. If you look at these, let's just go back here. The translation is more practical, and you may be asking why. Remember, under translation, use one rate, the current rate for both monetary and non-monetary asset liabilities, and the adjustment's cumulative goes to OCI. It's conceptually inconsistent because non-monetary assets and liabilities are valued at historical costs, like property, plant, and equipment, and so you should actually use the historical rate for those, not the current rate. But in this case, under translation, you use the current rate for both cash, accounts receivable, payables, and non-monetary items, such as property, plant, and equipment. So that's inconsistent, and the adjustment is cumulative and goes to OCI. It's not only inconsistent, or it may be, it may be inconsistent. However, it's simple. Notice that you only use one rate. Whatever the current rate is, you're going to multiply cash, receivables, payables, property, plant, and equipment, and other items by that one rate. It's a single rate approach. It has been known as a single rate approach. And that makes it easy. And you may be thinking, well, in a textbook world, it's what's the big deal? What's the big deal if shouldn't you do what's right rather than what's expedient? The problem is that finding historical exchange rates in the real world can be rather difficult because you bought a lot of companies have thousands of assets and liabilities, so they prefer this method. And for remeasurement, we looked at this already. The United States use remeasurement when the foreign subsidiary is a sales office. They don't have their own factories and make things in the other country. It's a sales office, which basically means it's just an extension of the United States company, and both of the companies work in the same economic environment. This is where you use remeasurement. Conceptually, it's consistent. Current rate is used for cash, receivables, payables, that's current. And the historical rate, non-current, has also been sometimes called the historical rate, for items that are valued at historical cost. That makes perfect sense. And the adjustment goes to net income, and it's only for the current year. So this is consistent. Here's the problem in the real world, though. It's consistent to value non-monetary items using the historical rate. But that means that you've got to look up the historical rate for each asset and liability. So if you have 1,000 pieces of equipment, which a lot of companies do, you've got to track 1,000 different historical rates, one for each item that was purchased. So you may have purchased something 2 years ago, piece of equipment. You've got to know the historical rate then. You may have purchased something, the company's subsidiary may have purchased something 1 year ago, you'd have to know the rate. If you purchased something 10 years ago, you'd have to know the rate at that time. That's not just a matter of complexity, it's a matter of cost. Companies don't like it. They sometimes use it, but if you look at most financial statements, you could actually imagine a company saying, theoretically, we should use remeasurement because it's more consistent, because we're basically exporting things. However, companies like to use translation because it's cheap. It's simple. And simplicity and cost mean something in accounting. Okay, so I'll put this slide up. I know it's a little repetitive, but the concepts are all here. I'll put these PowerPoint. I'll put the video up, and then I'll put the slides up with the in the assignment space, so you can kind of take notes if you wish. Thank you very much. Bye bye.